a realtor and talk show host all in one. Get tips, advice, and valuable lessons from the successful and rewarded Sotheby's Vice President, Jennifer Hammond. With more than 20 years of real estate experience, she'll make it look easy. Here is Jennifer Hammond.
Hello. I'm Jennifer Hammond, and I'm here with Linda DeMarla. We're talking real estate and taxes. Linda is our tax expert. She really specializes in understanding real estate and all of the ways that you can really take advantage of the tax code. And it's really important that you understand when you're buying an investment property, what are some of the possible things that you can do and some of the ways that you can really have an exit strategy so that you can buy more real estate properties. So let's talk about what a lot of people know as the 1031 tax deferred exchange or 1031 exchange, or there's a lot of names for this.
Yes, you know, it has a lot of different ones, and I'll go through them because they can also call it a starker exchange or a like kind, like purpose. It can also be called a tax deferred or tax free. It's really the correct term, the one that I like the most is the tax deferred, because what happens is when you're selling your investment property, if you intend to buy another property anyway, in other words, you're not going to keep the proceeds for yourself, then it would be better to not pay any taxes, so you have
Always.
more money. Yes, always. So you'll have more money to reinvest in the new property. So the way you can do this is under Section 1031 of the Internal Revenue Service Code. You know, these have been around for more than 100 years. They think it started back in the 1920s, actually, and even before I started doing taxes. But I've been doing them for my clients now for 30 years, and they're just wonderful. So maybe I better explain how to do them.
Right, so let's use an example. Say that we have John, who has bought a property and now he's owned it for a number of years. It's gone up in value and he decides he wants to sell it, and he's going to be making $300,000 profit.
Yes, well,
Okay.
if he just has an outright sale, he's going to owe capital gain tax on the property. And even though he owned it for more than 1 year and 1 day, he will get the long-term capital gain treatment. But it's still going to get taxed at well over 20%, not just
Right.
15, but 20. And he could be also subjected to the health care tax of 3.8. So let's try to avoid all those taxes. And,
Right.
and the way to do it is to defer the income. Now, he has to follow the rules, and they're very specific, and we'll go through them. But basically, when he sells his property, as long as he reinvests in a new property that costs as much as the sales price of his old property, and as long as he invests all of the money, all the proceeds from the sale of the property, number one, into the new property or properties, because it could be more, he is allowed to defer all the gain.
So for instance, that $300,000, he could go ahead and buy another property and take that and put that as a down payment in the next property. But he can't take $1 out of that $300,000. It has to be the whole amount.
That's right. If he doesn't want to pay any tax, he can't touch it. So let's say that originally he'd paid about $200,000 for a piece of land. And this very valuable land now has gone up to $500,000.
Right.
So if he sells it outright, bang, he's going to have to pay tax on the $300,000. We don't want that. That would be sad. No. Because he now would like to perhaps own some rental properties, whether they're residential or commercial. He's allowed to roll those proceeds into any kind of real estate. So it could be a gas station. It could be more land if he wanted to. It also could be an apartment building or a house, a condo, a small casino. I guess you could buy $500,000 casino.
But something that's is similar, another piece of real estate of some nature.
Some nature,
That's
right.
important, yeah.
Now, if his land that he's selling isn't located inside the United States, then the new piece of property or properties must also be located in the United States.
Okay.
If by any chance this land was located in Mexico or Canada or somewhere outside the United States, then he would have to reinvest in something also outside. He's not allowed to bring the money back. If he brings the money back, even though he buys something in the United States, then it would become taxable. Not too smart on the part of Congress, because you think they'd want you to bring the money back, but
exactly.
But when I make the tax laws, that one will get changed.
Exactly. Linda running for Congress.
Yes. Now, there is a little problem because there's some time factors.
Yeah, so let's talk about a time factor. So say, for instance, again, you know, our friend John, who has a $300,000 basically profit on this property, sold it for $500,000. He only spent $200 on it. Now he goes and he has this $300,000. That money has to go and actually go straight to an account that's held by
a person who's not him. So,
He
'cause
can't put it in his own account.
Yes, he cannot feel,
Yeah.
touch, smell, or have anything to do with the money. It's going to be held by what's called a qualified intermediary. Now, this qualified intermediary, it can be a person or a company, somebody that hopefully he trusts, because they're going to hold this money for up to 180 days. And this person is going to be, better show up at the settlement with the next property, for the next property. Now, within the first 45 days of selling his land, he needs to identify in writing and be able to prove it to Internal Revenue. He must identify the address or addresses of the replacement property or properties.
So that's an important thing. So we talk about in this area, there might be that you wanted to know to identify 3 different properties because there might be multiple offers, and then you might not be able to get the first one you were hoping for. So you could actually identify a couple different properties, correct?
Yes, and I always recommend to my clients to do so, just in case. You're allowed to identify 3 properties of any price. If you'd like to identify more than 3 properties, you're allowed to do so. However, the total cost of the more than 3 properties cannot exceed twice the sales price of your property. So if he's selling his land for $500,000, he could identify 4 or more properties. However, the total price could not exceed $1 million. And then there's also, you can go to Plan C, which is that if he wants to identify lots of properties, many, 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 as long as he settles on 95% of those within the 180 days, he qualifies. But normally what people do, like you say, is identify 2 or 3, and that's fine. Now, after he's identified the property, maybe one of them's already gotten sold. So within the 45-day period, he can re-identify a new property and unidentify one of the older ones that he doesn't want, or maybe it's already sold. But within the 180 days, and there's no extension for this, so don't, if the 180th day falls on a Saturday, he must go to settlement on a Friday.
Right.
And within 180 days, he needs to have gone to settlement on the new properties. And these new properties, in order for the tax not to be accumulated on any way, they need to cost more than the sales price of the land, and all of the money needs to go into it. However, let's say he decides he wants to keep $100,000.
Right.
Maybe he's got kids going to college. He can do so. He can put the 100 in his pocket, but whatever that is, it's going to be taxable. So whatever he keeps, that portion becomes taxable, not the whole thing.
Well, that's good. And let's also talk about the gotcha. What happens if he misses his time frames?
I'm going to cry. If he misses the 45 days, he's not allowed to change any of the ones that he's already identified. So he's stuck with those, and he can't come back and say, I'm going to settle on something else. So those, whatever's identified within the 45 days, on the 45th day, then the clock starts ticking, and he's got until the 180th day from the original settlement to get one of those into his name.
And if he doesn't, what happens if he misses it? Then he misses all the tax benefits.
Then he misses all the tax benefits, and all of the gain will become taxable.
Right.
Now, when you're choosing a qualified intermediary, it can't be anybody related to you. It can't be your accountant, you're a lawyer, you're a realtor. It has to be somebody outside that you haven't dealt with in the past 2 years.
Yeah, and I think that's really important. So if somebody's moving, for instance, from California over to the East Coast, where does the person need to be that would hold the money, the intermediary?
It can be anywhere.
Anywhere.
As long as they're a qualified intermediary. They can't be related to you by blood or business or anything else.
Right, and that's an important detail because, again, people are often thinking, well, could I still buy a property across the country if that's where I'm moving to?
Yes.
That's something that's really important to them. And they could buy 2 properties in 2 different states.
Yeah, absolutely.
Correct?
You can divide the money up. He could take that $500,000 and put $100,000 down on 5 different properties.
Right.
So now, instead of being an owner of real estate of $500,000, it could be $2,500,000 or $25 million or whatever it is. Whatever you're calling leverage other people's money.
Yeah, I always want to leverage someone else's money. That's one of the reasons that you want to be able to know these tax codes, know the tax strategies, have an exit strategy always planned when you're entering a property. But even if you're just thinking about, okay, I'm thinking I want to sell it in the next year or 2, what would that be? And what are some of the strategies? So this is called the 1031, also a Starker exchange.
Starker exchange, like kind, like purpose, and there's probably another one. I can't remember, but that's all of them.
But these are really important to know. This is an investment strategy when you're actually deferring taxes. And some people call it deferring till death.
Yes, yes. If you end up owning this property that you've never paid taxes on in the past,
Yeah.
and you're still owning it when you pass away, guess what? The taxes are all forgiven.
Yay! All right, well, that's our 1031 tax-free exchange or tax-deferred exchange. Very important. Again, this is Linda DeMarlar. She's with Tax Masters in Rockville, Maryland. She has a whole team of people that can help you if you're interested in finding out more about Linda helping you. And again, we're so happy that you joined us. I'm Jennifer Hammond.
Thank you for listening to Jennifer Hammond's podcasts. If you liked what you heard, leave a comment or like on iTunes. For more information, visit her website at jenniferhrealty.com.